Welcome to today's presentation. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia. And today I'm here to talk to you about how to bring your US retirement accounts back home to Australia in 2026. Just a few disclosures here to take notice of. Today's presentation does not constitute personal financial, tax, or investment advice. If a professional consultation is required, then you should reach out to the appropriate party. And please note the accuracy of information here, I believe, is very solid. But do note that, again, this forms part of the disclosures that I make about today's presentation. Our YouTube channel has been growing in popularity for people interested in these topics. I would encourage you to go check that out. You can see all of the 83 videos that are published over the last 10 years relating to topics that Australians in America or Americans in Australia face. You can even see this sort of AI version of me. It doesn't quite look like me, but here I am from last month talking about how the exit tax works. A little bit about my background. So I was really born into this cross-border financial situation as a citizen of the UK, Australia, and the US. Moved to the US in 2005, and that's where I began to ask myself, maybe there are advisors out there, or there's some membership organization or something like that that deals with cross-border financial issues. Turns out there wasn't. It took me years of research and networking to figure out that that was the case. In that time, really starting around 2014, I began to delve into this cross-border space. I've got a diploma in Australian financial planning. I'm a CFP in the US. I'm also the founder and executive director of the Global Financial Planning Institute. So I'm the one that actually teaches other financial planners what they need to know in working with cross-border financial matters. So my why do I do this? To me, it is about empowering people to make the most of their resources overall and experience greater global freedom through streamlined mobility. And that comes from being sure, having confidence about what the taxes are that you're going to pay or likely to pay in the event of a cross-border move. Someone has chatted in here. Okay, so Helen, thank you for that. These AI note takers are not allowed, so I'm going to remove that. I should just make you aware that that can sometimes kick out the person who has the AI note taker. So sorry about that, Helen. You're sorry, 1 second there. Okay. Let's keep moving on here, shall we? So, types of clients we work with. We work with the three types that you see right here. Notably, we do have $1 million minimum, given the smaller boutique nature of the firm. I should mention, I'm a proud member of the GFP Institute. And if you have a friend or family member or someone who needs cross-border financial advice to somewhere, including Australia, of course, then feel free to go check out the GFP Institute, where you can click on Find an Advisor and locate someone with the appropriate expertise. All right, getting into today's presentation, here's what I have for you. So first, we're going to be looking at US retirement accounts under Australian tax law, then moving into tax and currency implications, strategic timing considerations, superannuation contribution strategies and recontribution strategies, ongoing US tax reporting obligations, common pitfalls to avoid, and then some case studies and planning frameworks to bring it all together. All right, so the US and Australian tax system, this is really the case globally. It's not specific to Australia and the US. It exists almost everywhere except for between the UK and Australia, where there's a system called the QROPS that allows for you to move your UK retirement plan to Australia. But practically everywhere else, there is a misalignment. There is a situation where the US does not view superannuation as a qualified retirement program, and Australia similarly does not view the the US as running a qualified superannuation program. So the way that these end up being taxed is essentially a distribution out of one is often a taxable event, foreign exchange, and then is there a possibility to recontribute into that foreign retirement program? The answer is very often no if you're moving from Australia to the US, and very often yes if you're moving from the US to Australia. But whether you're able to participate in that recontribution is highly dependent on your US legal status. And that hasn't been spelled out very well in today's presentation. So the recontribution strategy doesn't really work if you're a green card holder or a citizen. And the reason is because of the view that the US takes on superannuation, which conveniently is the topic of the next presentation I'll be doing. So what makes the US somewhat unique? I say somewhat because China and Eritrea have a similar system, and that is that they tax their citizens on a global basis. It doesn't matter where you go. If you were to move to the UAE, let's say, to be in a lower tax environment, you would still be on the hook for US taxes because of this global situation that the US enforces. And it's done by way of the savings clause with in the case of Australia, at least, it's Article 1.3, and it's called the savings clause. It came about due to the Civil War. As a matter of fact, the US wanted to tax people that were moving away, particularly into the Caribbean, to avoid them not paying for the cost of the war that they may ultimately benefit from in some way. Australia operates much more like the rest of the OECD countries, and that is if you're physically present in Australia or you satisfy that there's 4 different definitions of tax residency in Australia, but if you meet one of these definitions, then you're going to be deemed an Australian tax resident. Alternatively, if you're living overseas and you have Australian, what's called sourced income, so you own an investment property or you receive distributions from an Australian trust, that would be taxable Australian income. But if you're merely working, let's say, again, in the UAE, Australia is not going to tax you on that income. So there's a big difference that happens right there. So Article 18.1 of the US-Australia Double Taxation Treaty is the relevant article in the tax treaty that deals with retirement account distributions. And broadly speaking, it says if you are a tax resident of one of the 2 contracting countries, Australia and the US, then you're taxable only in that country. Now, here's the rub with that. And this is for those of you listening closely, you would have put 2 and 2 together here. That means if you are not a US tax resident, then you'd only be taxed by Australia. But if you continue to be a US citizen or green card holder, then even though 18.1 says you should only be taxed in the country that you're in because you're still a US tax resident, basically it doesn't apply. And so you're going to end up paying the higher of the 2. So understanding US retirement accounts eligible to transfer. So I've listed the major types here. The wonderful thing, and I guess what keeps me busy is there's many different types of US retirement accounts not even listed here. There's 401(a)s, there's non-qualified deferred compensation plans, there's all sorts of other things. But broadly speaking, the US tax treatment for traditional types of accounts, 401(k)s, 403(b)s, traditional IRAs, works like this. You'll get a tax deduction for the contribution on the way in, grows tax-free throughout the accumulation period, and then on the way out, it's taxed at ordinary income rates. Roths, however, Roth IRAs and 401(k)s is exactly the opposite. It's funded with after-tax dollars. It grows tax-free and then comes out tax-free. Interestingly, they're actuarially equivalent, meaning that provided one's tax bracket doesn't change from contribution through retirement, you actually end up with exactly the same amount of money, depending on which of those you choose. However, in reality, it's often the case with good planning, if you make contributions that are beneficial, that are going to bring you from a higher tax bracket in your working years to a lower tax bracket in retirement, then there is an opportunity for you to save some money by making use of retirement accounts. And very often that is the case. In fact, that's kind of I would say one of the underlying principles of financial planning is transferring from one stage of life paying a higher tax rate to a lower stage where you're paying less. Okay, so in Australia, we're dealing with Section 99B. And Section 99B views these US retirement accounts not as Internal Revenue Code Section 401k or 403B, because there are no Internal Revenue Code sections such as that in the Income Tax Assessment Act. Instead, we have to make sense of these foreign retirement accounts through what tax law exists in Australia, and that's where 99B comes in. So 99B looks at a 401k and says, we don't know what this thing really is. We think it's a foreign trust. How do we tax foreign trusts? Well, that's pretty straightforward. There's the corpus of the trust, Latin for the body of. So the corpus of the trust would include the employee plus the employer's contribution, which leaves the growth component of the account. And the growth, for better or worse, is what's taxed at ordinary income rates back in Australia. Now, I do want to emphasize this is of particular relevance only to two groups of individuals, and that is the Australians who are temporary visa holders, or those folks that have either relinquished their US citizenship or have relinquished their green card. And the way that you would do that, relinquishing the green card, is submitting a USCIS Form I-407. So if you've merely let your green card lapse, that does not relinquish your tax obligations. That's done by I-407. Please check out last month's presentation. I just had someone inquire in the last 24 hours about exactly this topic. He said, should I keep my green card or not now that I'm moving to Australia? And the answer is actually pretty straightforward. You won't be able to keep it for very long anyway. You could keep it for maybe 2 years before it lapses. But the important thing is your US tax obligations. They don't ever go away until you file Form I-407. But the key is, would you be considered a long-term US resident, which would mean you've held that green card for more than 8 of the past 15 years. And if you meet one of the 3 tests that apply, you could be considered a covered expatriate subject to an exit tax, and your heirs, your US tax resident heirs, may be subject to a 40% inheritance tax. So you definitely want to do your homework before you file that I-407 to make sure that you're not inadvertently triggering an exit tax that could affect you and your US tax resident heirs. Okay, so that's really the main point I wanted to make here. Just reading this critical point down the bottom, while traditional accounts offer manageable transfer pathways with only growth tax, Roth accounts should be liquidated. I think the language used here in the slides is a little alarmist. We don't typically see people with Roth accounts more than a couple $100,000 at the most. So while the advice is sound that you don't really want to be moving with the Roth back to Australia, it's not the end of the world. Yes, you may pay a bit of double tax, but because the balances don't end up being that high in the first place, it's not the be all or end all. So don't lose too much sleep if you do have a Roth. And also remember, oftentimes there will be ways to get your money out of a Roth. If you're over 59 and a half, you could simply withdraw the money. That would be one way of dealing with that, and no doubt a superior way of dealing with that, actually. As I've alluded to prior to this slide, your US legal status determines your transfer options. So the citizen and the permanent resident are really in the same boat, that there's the saving clause coming back to us yet again. The temporary visa holder, this is particularly the E3, the L1, the O1s, the H1Bs, less than H1B for Australians. These are the folks where the clock never started ticking on them with regards to the exit tax. So they don't have to worry about that. They come back to Australia And I don't mean for a holiday. If let's say someone's back in town for a week or two over Christmas or for their sister's or brother's wedding or something like that, you're not going to become an Australian tax resident in such a short period of time if your employment, if your rent agreement, if everything is still in place in the US. It's more when major facts in your life have changed. For instance, you've quit your job, you're done with the US, you're moving back to Australia, your lease is ending, et cetera, et cetera. That's when you return, you're going to become an Australian tax resident and you'll be done with the US in short order. Exactly when you'll be done, however, I hold off on that. I'd say talk to your international CPA because everyone's facts and circumstances can be slightly different and can change that. Your legal status at the time, this is the point I'm trying to make here, is the critical variable. So US citizens face permanent worldwide taxation. They would be mindful of that age 59 and a half and waiting to distribute until that point in time. Same with the green card holder, and former visa holders gain the most flexible transfer options. So Greg DeWett has written in here, how is Corpus determined if I don't have official IRA statements from the time I became an Australian tax resident? Greg, that's a great question. And the answer is not so straightforward, to be honest, because the US custodians, let's keep this in mind. The US custodians, they don't know that this is a commonly requested statement. In fact, I'd say let's reword that. It is not a commonly requested statement because most employees at US companies are not foreign people in the first place. And so this only comes up for foreigners. It can be very tricky. I probably should publish, I've got an internal wiki page on this, how you construct a cost basis if you're in precisely the situation you're describing. Ultimately, it's up to your Australian CPA to sign off on that and say that they're satisfied that you've proven it. Some of the ways you might do that might be if you have W-2s if you have pay slips, then what you could show is, hey, I made this much money, I contributed this, I had an employer match, a summary plan description of the qualified retirement plan that you had at the company. The company offered a 3% match. I contributed the max for the 10 years that I was working in the US. Therefore, I must have contributed this amount. My balance of the account is this. Therefore, the growth component is that. That would be fantastic because here's the bad news. Without that, without a justification, without paperwork, the ATO assumes the whole thing is corpus, which is probably the worst news I've had to share all day with you, but that's how the ATO works. If you can't prove it, they just assume the whole thing is growth, which to me it's offensive and that they would do that because how could you fund it how could you have any balance above zero unless you had an employer contribution plan that was made without you making any contribution, which is extremely rare. They're almost entirely match systems in the US. Anyway, I'll get off my high horse about that one. Karen Thompson writes, sorry if questions are not yet being answered. Been listening for a little bit, but first time live on the webinar. Well, welcome. US citizen with Aussie partner, planning to retire with Australian partner in Australia in 20 to 30 years. Okay, that's called planning ahead. Unsure where we'll be in the meantime. Should I keep investing in Roth and deal with it then? Probably, because Karen, I don't know how old you are, but if you're talking about retiring in 20 or 30 years, it's safe to say the average age of the people that listen to these webinars is probably in the 40s, 50s, 60s. So add 20 or 30 years would put you over age 59 and a half. If you're over age 59 and a half, you could withdraw it at the time you transfer. So that wouldn't be such a bad thing to do. If you find yourself staying in the US, then it would be an advantage to you. Ash Forsyth has raised his or her hand. You might like to just chat your question in there. Ash, 35 and thanks. All right, so 25 years from now, you'll be 60 unless over that threshold. All right, next. So Australia's Section 9 ITAA 99B taxes US accounts as foreign trusts, but only the growth component. That was the takeaway from the former slide. Growth versus corpus, got to be clear, got to be able to justify how much is which. The growth, unfortunately, is taxable at ordinary income rates up to 45%. You hit the 45% at $190,000, of Australian income. So what this is leading to for people that are paying attention to how they might be impacted here, if you had a larger 401k or 403b or IRA balance, and you were wanting to distribute that to Australia, and you had more than $190,000 of growth, Australian dollars of growth. Remember, we got to convert from US dollars back to Australian dollars. You might do well to consider realizing that over a couple of years. You don't need necessarily to distribute that all at once. So you might take that over a period of time. The key insight here, the ATO's foreign trust treatment can work in your favor. ATO guidance confirms that Corpus is excluded from assessable income, meaning, and this is to Greg's point earlier, documentation of original contributions is critical. There's a question here from Andy Zen. Is there any penalty in the ATO's eyes if someone were to liquidate a Roth IRA and roll it over into a traditional IRA? Would the ATO need to see the original Roth IRA amount and then have that amount subject to taxation as it would be considered growth? Andy, that is a fantastic question. And the answer is I don't know. And that's because I'm not a CPA. That question really comes up to the limit of my knowledge. I work with tax counsel who deal in precisely those questions. It would seem to me that it would be viable, but I don't know the point, to be honest. I kind of think like it's too clever by half. Like, why not just distribute the Roth IRA to a taxable brokerage account, and assuming you're not a US tax resident, move to Australia, get a step up in basis on low basis assets. That would be an even better way to go about that rather than recontributing to to a traditional IRA, which you'd have to prove the growth. I wouldn't see the point of doing it, but that's just my 2 cents worth. The Roth IRA presents a toxic tax scenario for Australian residents. Like I said, I didn't really want to harp on this that much. I don't think they're that bad, again, because the balances don't end up being very rarely would I see a Roth balance in excess of $250,000, for instance. And I would say I've never seen a Roth balance more than $1 million. Interestingly, Peter Thiel, he has what is it? It's something unbelievable. He's got a Roth IRA with billions of dollars in it, and he was able to achieve that because he put some of it's like Google or Facebook stock into a Roth IRA, and he did that. It must have been a self-directed Roth IRA before the company went public, and now that's what he's got. Interesting aside. Okay, so the US IRS view of things, Roth contributions are made with post-tax dollars. They grow tax-free. They come out tax-free, assuming you've held it for 5 years after age 59 and a half. There's no RMDs. So they're a great estate asset as well. If you're thinking of intergenerational wealth, why leave a tip for the IRS? There's no need to do that. You can begin planning for future generations and how much total lifetime or generational tax you might pay between the two generations. That's really, really considered planning that Karen would be proud of. She was thinking of 20 or 30 years, but you can go out even longer than that. Thomas asks if I take my RMD as a CMD. I'm not. Do you mean a charitable? What's it? I don't know what a CMD is. Do I need to report to ATO? Maybe you could write what a CMD is. Yeah, it's I don't, if you're thinking of a charitable contribution, then I don't know the answer to that. I would still think yes, and the reason why is, and that's limited to $100,000 anyway. It would still be reportable, I'm pretty sure, because that's tax deductible on the US side. You're looking for these rare instances where the tax codes line up with each other and they treat the exact same thing in the exact same way. It's possible that it does, but very unlikely. And the reason why is because, and I've done webinars on this in the past, I think it was 2022 that I was last talking about this, where even if you made a contribution to a 501c3 In the US, that's a tax deductible organization, a charitable organization where you can make tax deductible contributions to. There's no 501c3 in the Australian tax code. So they might not recognize the same charitable organizations as being qualified entities, and they probably don't. So that's really the philosophy to arm yourself with is the exact same move going to be treated the exact same way by the other taxing authority? And I think the answer is probably no. In 99.9% of charities, maybe the Red Cross, something as big as that, there might be a way around that, but couldn't say for sure. That's one for the tax attorney, to be honest. Not even the CPA. I'd say that's a tax attorney type question. Okay, the ATO views on Roths. ATO, they don't recognize Roths. They're treated exactly the same as traditional IRAs, 401ks, 403bs. The Corpus enters Australia tax-free. The growth is subject to ordinary income tax, so you end up paying tax a second time. No, thank you. Now we're looking at exchange rates here. So current volatility is actually bringing us closer to 0.71 cents right now. It's really bounced around. It was just 2 weeks ago I sent a client alert and I said, if you have money that is ready to convert immediately, do it now, because it dropped back below 69 cents, which it had not done prior to February 28th and this misadventure in the Middle East starting. So key currency drivers that we're seeing right now. I think for the first time in a long time, I'd say some clarity has opened up, and that is with what's happened with oil prices. It's looking like in both the US and Australia, we're probably looking at rate rises to deal with this. And I just want to make a quick aside. I think you'll all appreciate this. To me, I was kind of baffled about why would they raise interest rates when oil prices are increasing, which is effectively like an interest rate increase in the first place. And the answer turns out to be because the central banks absolutely want to stop this wage price hike spiral that can happen. And so they want to nip this in the bud. They want to prevent, by raising rates, they want to trim demand and cut the idea of inflation taking off as a phenomenon and it gaining momentum. Okay, so maybe rate increases, widening rate differential, at least for the time being. We'll see what happens. Things in Iran could end very quickly, is what it seems like to me. There are very few, not zero. I think there's a Marine Expeditionary Unit in that island up north, in that key oil loading island name, which is escaping me right now. But other than that, I don't think there are any other boots on the ground. So this seems like a war that could end very quickly, indeed, if some accommodations can be made on either side. Bank range forecasts, we're seeing it's not going much lower than where we are today. So 0.69 is what the banks are thinking, with the upper end going as high as 79 cents. I don't think that's unreasonable, especially if you look at the projections for US federal debt and how that's going. There was an article just today in, it was The Economist actually, where they're talking about, now the Democrats are talking about tax cuts, their plans are to be reducing taxes as well. And everyone likes the sound of that, but when you consider that the government already has the largest amount of debt that it's had as a percentage of GDP outside of World War II, then you begin to think maybe that's not such a good idea. We should be increasing, not decreasing taxes. Geopolitical headwinds, spoken a little bit there, and then China stability. So March data is showing that China is now becoming a more consistent customer for Australia's resources. So converting during periods of relative weakness, Australian dollar was floated in 1981. The average over that period has been between 72 and 74 cents. So to be at 71, it's not much better than average, but it's a little better than average. So it's maximizing the value of US retirement distributions. You could sit around and wait for it to return to 65 cents. Maybe it will, maybe it won't. It can be very volatile in the short term, but in the longer term, we're seeing a strengthening of the Australian dollar, weakening of the US dollar. Institutional foreign exchange channels can save you a lot of money. So when you're going to convert your US dollars to Australian dollars, you need to be aware of what the exchange rate is. And most people, and I think this is a business strategy that's intentional. The foreign exchange people do not want you to know how they make money. And they make money on what's called the spread between the interbank rate and the rate that they offer you. So the interbank rate is what it is. It's the published rate that's out there. And they charge their spread, which you can see here, spread over interbank, right here. And the most easily accessible rate that I think you're going to find would be with Wise or with Currencies Direct and OFX. We have arranged institutional discounts with those partners, so they're going to be cheaper than what you'd get off the street. The street price, the retail price is typically about 0.6, 0.5 to 0.6, excuse me. So quite a bit cheaper. Schwab, they will, and Fidelity probably will also. I don't know Fidelity for sure. I know Schwab will also do foreign exchange, but they're not that competitive. They want to make a little bit of money on the Forex conversion as well. But what I've done here in this table is to make it easy to share with you and identify the spread, how much it's costing you, depending on where you're getting your money converted. So if you were to be using a retail service, or heavens forbid, oh my goodness, your bank, if you're using your bank, converting $1 million, you'd be paying essentially $31,000 to the bank for the privilege of converting that, compared with what you could have paid, which would be way, way, way less than that. I don't want to promote Interactive Brokers. I'm publishing it just here because it's true. They really do have the lowest, but Interactive Brokers are I've found them very difficult to work with, and they're not happy to be used for foreign exchange. They're not a foreign exchange broker. They are an investment custodian. So you need to have a long-term investment relationship with them, and then they will offer you Forex. But if you don't have that, then they will often close or restrict your account. So it's not a viable alternative, and that's why I'm referring more to the Wise and Currencies Direct and OFX options here. Actually, just on this note, I'm going to tell a funny story. So I had a prospective client. This was back in the late teens, must have been 2017, 2018, and she works in tech, or she worked in tech in Silicon Valley. And what she would do is she'd save up her US dollars for her annual trip back to Australia, because in her family, this law had taken hold that there was a money converter at the back of some flea market in Melbourne, and if you went to her, this lady at the back of the flea market, she offered the best exchange rate out there. And I was horrified to hear about that, because I thought, well, I don't know if it's legal. I don't, and furthermore, I don't know what benchmarking you've actually done against the interbank rate, but I'm telling you, this is how this is how it works. If you're seeing a little old lady at the back of a flea market to do your foreign exchange, then you're probably not getting the best rate, or it's probably not entirely above board. Okay, updated 2026-2027 superannuation limits. Let's take a look. So what sort of limits do we have with super? There's two types of contributions, and they essentially mimic the types of contributions you can make to a US qualified retirement plan. You've got your concessional contributions. That's currently limited to $30,000. So you can take a $30,000 tax deduction in making that. I think the people that benefit most from making that deduction are folks whose income is below $250,000. Why 250? Because above 250, you get slogged with Division 293, which is a bonus. It's not the kind of bonus that you want to get. A bonus 15% contribution tax. And that's the thing that's rarely ever mentioned about super, is that when you make a concessional contribution, not you, but your super fund collects a 15% contribution tax and pays that to the government on your behalf. So technically you didn't pay it, but it's still your money that's being used to pay it. So I don't see the difference. You can't take, unfortunately, a US foreign tax credit on it, because the way that foreign tax credits work is that you have to pay the tax, and because you don't pay it when it comes to concessional contributions, you can't take that tax deduction. I think, again, very unfair, but that's the way it is. Okay, so these amounts, it's rising next year. They do that every couple of years. Let's say every 3 years or so, you see it bump up by $2,500. We're also seeing an increase in non-concessional contributions. So the third bullet point there in the top rectangle is there's a carry forward contribution type that came into existence in the financial year 2018-19. And that means you can go back up to 5 financial years and make any unused concessional contributions on your behalf. And that may equal as much as $175,000. We need to keep that number in mind because when we get to strategies about recontribution, that number is going to be very important. Non-concessional contributions. Okay, so this is equivalent to your Roth type contribution. It's paid with after-tax dollars. Conveniently, there's no contribution tax on non-concessional contributions. You don't have an ability to use past year's unused amounts, but you do have this thing called the 3-year bring forward rule. So you can do, in the current year, it's 120, that's rising to 130. If it were April, if we were in the last quarter of the financial year, then I would probably be recommending that people don't use the bring forward rule quite yet. Instead, they make a $120,000 non-concessional contribution in the current financial year. Simply wait 3 months, and then on July 14th, come along and make a $390,000. Use your next 3 years of contributions at that point in time, and you've been able to get serious money into, so the $510,000 is how much you could get into super, assuming your total balance was below that $1.84 million limit that we're seeing in the third bullet point there. The transfer balance cap. What's that about? The way I communicate this to clients is I say, you win the game of superannuation if you and your spouse can get your super accounts to this particular number. It's now rising from 2 to 2.1 million. You win. Why? Because you can convert that entire balance from the accumulation phase to the pension phase, where it will grow tax-free and it will come out tax-free. It's the holy trifecta, the holy trinity of tax goodness. So you've been able to make tax-deductible contributions, tax concessional growth in the accumulation phase, but then in the pension phase, it's tax-free growth, tax-free distributions. Doesn't get better than that. If we use a back of the envelope, let's call it 4 ranges, depending on the sophistication of who's involved, 4 to 5% sustainable withdrawal rate on that number, you're talking about $80,000 to $100,000 of tax-free income for that Australian resident, plus your spouse, another $80,000 to $100,000 of tax-free income that you're taking from your super account, and life is good. So despite what's going on with fuel prices, if you're living on a retirement, if you own your own home, living on a retirement income of $200,000, not paying any tax, things are pretty good. Division 296. So this came into effect. This has been all over the news for the past year or so. Doesn't affect that many people that I've seen. Maybe it's a function of who I work with this cross-border niche of mine, but rarely do I see folks getting super balances that are in excess of $3 million. I've got a couple above 2, but not many above 3. So the tax has changed there, and Labor did concede a few points here, which I think is what got this done in the end. And that was originally they were talking about taxing it on unrealized earnings. So even if you didn't sell the account, they were still going to hit you with this tax. That causes problems because where does the money come from to pay a tax that you had no cash created from a realization event? So they changed it. It's now just unrealized earnings. And essentially, you get hit with an additional 15% tax on growth in that portion of your account. So cross-border implications. What's the point making down here? The increased contribution caps and carry forward rules create a larger landing zone for repatriated US retirement funds. Yes, but still need to be done strategically. And it's going to depend on your US legal status and the time frame that you've got to be able to distribute those accounts. So that's, and it allows up to 565. That's in the current financial year. It says across two strategies within one financial year. So that is correct. I fixed that up. Two strategic paths exist on a US person. Two strategic paths exist based on US person status, meaning legal status. Super recontribution versus the periodic distribution. This is what it all boils down to. I tried to make this as interesting as I can, but here is where you really want to pay attention. You're either going to have been a US temporary visa holder and thus returned to Australia. You've got no US legal status any longer, or you were a permanent resident and you got rid of your green card, or you were a citizen and got rid of your citizenship. Then path A applies to you. This is when you can use the super recontribution strategy. What does this look like? This looks like you take Article 18.1, fill out your W8BEN form. You say, I'm referencing the tax treaty that Australia has between with the US, and that very clearly calls for 0% withholding. And that is okay. I'll say this now, and I'm sure someone will write in with a comment or question and ask me again if they're hearing me right. Bad news indeed. And that is, despite completing a W8 Ben and submitting that even to Interactive Brokers, Schwab, I'm sure Fidelity would be the same, they changed their mind on this back in 2020. I don't know what happened exactly. They got burnt somehow, and they just said, listen, we don't care. Thank you for submitting your W8 Ben, but we are not in the business of determining whether this applies to you. And so we're just going to withhold 30%. We don't care. Excuse me. You take that up with the IRS next year when you complete your 1040 NR, which is the non-resident return. In that, you're going to submit your W8 BEN, your what is it, your 1041S. Sorry, I'm forgetting the exact form code on that one. But there's another form that you'd need to submit and say, hey, you shouldn't have withheld anything. I've seen this many times. It's not especially controversial. You get your money back and life goes on. But there is very likely to be that over withholding from the US custodian because they've got nothing to gain by not withholding because they've been burnt in the past and they don't like that. Okay, so in recontributing back to super, you need to think about how much growth do you have in your account. That's going to vary by individual. I've had clients that spent time in the US in the 1970s, they returned in the 80s, and they have 95% of their account is considered growth. More often, I get clients that recently moved back and their accounts may have less than 10, 20% growth. And the balances, of course, vary tremendously from one person to another. But here are the contribution tools. You'll look at the amount that you've got in growth. You compare that to the marginal tax bracket that you're going to be in the current financial year or the next financial year. You'd say, I've got the use of the 5-year concessional contribution carryback tool. I can offset $175,000 of income to bring that down. I'm going to contribute that into superannuation. The corpus that was not taxable in Australia, you can send that into super by using the non-concessional contribution limits. And then over a couple of years, you can get this money in. There is another limit that I should mention, and that is if you've got a balance in excess of $500,000, you can't do the carryback contribution. So that's limited to $500,000. So this is where sequencing comes into it. I'm working with a client who is in exactly this situation right now. He returned from his time in New York last year, built up some nice balances in a taxable account and also in retirement accounts, moves back to Australia. He gets a step up in value on the low basis taxable account assets, so the company stock, for instance. And then the retirement accounts, I'm struggling to recall if he was able to get a step up on those because that can happen too, but that's part of the secret sauce that we keep a little closer to our chest, what I was alluding to there. There is known to be a way to get a step up on your retirement accounts as well, and that's something we help clients accomplish, but it's not something I go into in public webinars. So in his case, we have entered into a multi-year, that's right. I don't think we could for him because of various facts and circumstances. He retained employment with his US employer after he left, and that meant that there was no what's called separation of service, et cetera, et cetera. So what we're doing is a multi-year conversion to make use of his 5-year carryback, all concessional contributions, and we're trying to get that all in while his balance is below $500,000. So there's a lot of moving parts to figuring out how much and what type of contribution should be made. So Mr. or Ms. Paredes writes in, hi, Ashley, what happens if you haven't submitted a tax return in the US for over 10 years and your broker takes the 30%? Do you think it'd be wise to submit a 1040 NR after being dormant? Thanks, Steve. Okay, that's a Mr. Paredes. That's a tricky one. I think you're poking the bear, to be honest. I think you'd do well to get caught up to speed with that. Presumably, Steve, in your case, sorry, I just picked up something. If you're sending a 1040 NR, that implies that you're a non-resident, but you haven't submitted your tax returns for 10 years, and you would only be required to submit your tax returns if you were a US tax resident. So maybe you want to clarify your US legal status, because the question exactly as it's written, they're mutually exclusive. You couldn't submit a 1040 NR unless you were a non-resident, and if you were a non-resident, you wouldn't need to file those tax returns in the first place. So maybe you could clarify that. Hi, Aaron. Hope you're well. Is there an advantage to reneging US citizenship before 59 and a half to follow path A, since I'm only 50? If I followed path B, I'd be keeping my US accounts potentially for 20 more years. Wow, Aaron. Is there an advantage to reneging? Yes, there is. And the answer is yes. The sooner the better. And the reason why is because more of your retirement account will be considered growth on the Australian side. So the sooner you relinquish, the less of your account is considered growth, which means the tax impact on distributing in Australia will be reduced. That's the broad situation I see there. Okay. Andy, again, under Path B, when taking the distributions out, how does the ATO determine which is growth or which is corpus? It comes back to your paperwork, your justification. So have you satisfied your CPA that you indeed did contribute the amounts that you say that you did? With the ATO, calculate the percentages based on the total account value of growth to corpus and tax the growth portion of each distribution. They don't just go straight to 45%, Andy. You work your way up through the brackets to ultimately hit 45% plus the 2% Medicare levy. But really, the take-home key point here with the periodic distribution review is, if you are still a US citizen, as I am, for instance, and as many of you today are, then you're probably looking at a multi-year distribution strategy to avoid spiking your marginal rate. Bronwyn. Hi, Bronwyn. Thank you for joining us. Following from Steve, what happens if 30% is withheld if you're a green card holder that has formally completed all tax requirements of handing green card back and haven't filed US returns for 10 years? Time to talk to the CPA. Where was Erin? She said, speak to a US tax accountant to get up to speed. Yep, that's the answer there. You've got to be compliant. I mean, it's as simple as that. That's yeah. I guess I'm lost for words, because I hate to be the bearer of bad news, but it's going to be a big project for you to undertake. You're going to go through what's called the Offshore Voluntary Disclosure Program. Probably have to file at least 5 years of those returns. There may be some penalties involved, but at that point, you eventually get caught up to speed, and you can access those accounts and sleep well at night. Thomas writes, are you going to talk about strategies for withdrawing IRAs? Yes, I am. Harry writes, if I have a superannuation account in Australia plus multiple 401ks in the US, I'm a dual citizen. What is the best approach in the future once I retire? Welcome to Path B, Harry. That's the answer there. Path B, for you, it's all about the periodic distribution strategy. Karen Thompson again, any issues with two partners taking different paths? Well, assuming that in your partnership that one of you is a non-US individual, because If you are, then that would apply, and if you're not, then it really just wouldn't apply. So it's the facts and circumstances of your U.S. legal status are really what's going to govern how you go there. Someone has written a question in the Q&A. I'll see if I can see that. Andy Zen again. Okay, Andy's he's hitting both. All right, I'm going to just close the chat panel and continue on here. So the periodic distribution strategy, I could probably do an entire webinar just on the periodic distribution strategy. I've got a case study coming up so I can dollarize the difference that you'll see. It's not as dramatic a saving as what you see with Path A. And the thing is with Path B, it also doesn't include, and we don't talk about it today because in financial planning, almost every topic is connected to every other topic. So you bring up distributing your US retirement account, and the next thought bubble attached to that is recontributing to super. But we don't recommend that for US tax residents because they could easily trip up and create a foreign grantor trust, and then foreign grantor trust treatment of their super account, which is not desirable. So for the periodic distribution strategy, we're mostly just talking about distributing to a taxable brokerage account. This brings up another issue, and that is if you're distributing to a taxable brokerage account, how do you then invest that? Well, as a US tax resident, you've got to worry about passive foreign investment company issues. So there's only 3 approaches for how to invest in Australian dollars, if you're a US tax resident. That's number 1 is the most boring, and that's bank products. So term deposits, high interest savings account. Very, very dull. Number 2, individual Australian stocks. It happens that we're launching a strategy available through the Australian partner that I work with. I don't think I mentioned that before, but I'm the only wealth advisor to my knowledge that is duly authorized and educated in Australia and the US. So our Australian partner has a direct strategy where you actually own the underlying stock, and that gets around the PFIC issue. The third approach is a US exchange traded fund. So technically it's in US dollars, but bear with me for a second. You invest in this US ETF, they immediately convert your money back to Australian dollars and invest in an Australian index. So it's an index fund, very low cost, but you don't benefit from franking credits. Franking credits are the prepaid taxes that companies have made before, sometimes, not always. They sometimes pay their company tax at a rate as high as 30%, and then they can pass that credit on to the end dividend receiver. If you're an Australian tax resident, you could benefit from that. If you own one of these US ETFs, even if you're living in Australia, you would not get the benefit of the franking credit. So that would be a disadvantage there. Okay, so we're talking the periodic distribution strategy. You're talking about distributing over years, and the math becomes pretty compelling once you see a spreadsheet of how this works. We're trying to stay out of these higher tax brackets. That's the whole point. In this example, you can see we're targeting that 12 to 22, ideally 12, but sometimes higher incomes will push you over at that limit. I'm still seeing that question in Q&A. I'm going to just make that go away so we can continue and focus on what we're looking at here. So Path A, the super recontribution strategy, maximizes tax efficiency for non-US persons. All right, step 1. You're clear as crystal that you're no longer a US tax resident, because this would all be for nothing if you did it while you're still in the US, because you'd get hit with penalty taxes and so forth. This is only once you're back in Australia and you are absolutely sure that you're not a US tax resident. That being the case, you send over to your US investment custodian Form W8BEN. They look at that, they put it on file. They're probably not going to honor it, unfortunately, as I mentioned before, but it's nice that you've followed the proper protocol. So in theory, they distribute your entire retirement account. Probably not going to do that. They're probably going to say, we don't make those determinations. That's the IRS's job. We're going to withhold 30%. You come back April 15th the following year. And now, by the way, this just in, I've got a good memory, but sometimes a little slow. It's the 1042S that you'd need to submit along with your 1040 NR. and the W8 Ben that the custodian holds to say, hey guys, you over withheld on me. I'm an Australian tax resident only. We've got a tax treaty. It's pretty clear. I should only be taxed in Australia, which means the US, sorry, you don't get your hands on this. Thank you very much. Okay, next, liquidate and transfer. So ideally within 6 months of residency, I'm not going to talk about, in case anyone asks, if it's there in the chat, I haven't seen it already, but I'm not going to talk about this thing called applicable fund earnings. AFE is what the acronym is, largely because the accountants I've spoken with have said they've never heard of it even being applied. Greg writes, a webinar on Path B would be great. I'm 60 plus with 2 IRAs. All right, 1 vote for Path B. And Paul writes, under Path A, is it correct that if you withdraw a lump sum of, say, $1 million, any excess over the recontributed amount is taxed at marginal tax rates? That is correct. Any growth would be taxed at marginal tax rates. So you would possibly look at a blended approach of Path A. Yeah, that's right, Paul. That's a good observation. It's going to depend. I mean, this is the thing, is when you get into individual circumstances, it's going to depend tremendously on one's tax bracket, the value of the account, all sorts of things. But yeah, if you had a $2 million account where half of that was growth, it's going to be $1 million Australian dollars at ordinary income rates, you're probably going to want to convert that over a period of years. So it's almost as though a Path A becomes a Path B, even if you're not a US person, because it's all about managing the marginal tax bracket. Okay, so where did we get to? Step 2, liquidate and transfer, get more money for your money with a good foreign exchange provider. Step 3, excuse me. So step 3, shield the growth with concessional contributions. And lastly, shield the corpus with the non-concessional contributions. Okay, and in the interest of time, I'm going to speed things up a little bit here. So the periodic distribution strategy enables US persons to balance dual jurisdiction tax exposure through staged, and my goodness, look how many syllables are in the title of that slide there. So US tax side optimization, you're trying to stay below this exceeding the 22% bracket. There's not a huge jump to the next tax bracket, but there, in terms of percentage, you move to 22 to 24, but there is in terms of income. So where are we here? $211,000 for a retiree. That's, if you're talking about annual distributions in US dollars, that's close to 300,000 Australian dollars. You're living large. Life's pretty good. So to stay below 22 shouldn't be a huge challenge for most people. Remember, you want to avoid that early withdrawal penalty, and you do that by waiting until after age 59 and a half. There is this obscure Section 72, what's called substantially equal periodic payments rule. I've never seen anyone do it. I've recommended it a few times, but then the operational complexity of it kind of becomes a bit overwhelming, and people say, you know what, I'm just going to wait till 59 and a half. Okay, Australian tax side management. This is kind of where we come in again about minding our marginal brackets. Keep it below 135 to stay in the 30% bracket. And above 190, you're in 45% territory, which we don't like. And don't forget to take your foreign income tax offsets. That's what they call it in Australia. They call it a foreign tax credit on the US side. Don't forget to file your forms. The US loves these reporting forms. People often misunderstand this. They say, oh, I'm not going to do that. They don't need to know. Well, they're not going to tax you. This is reporting. It's information only. There's no additional tax that comes from filing an FBAR or an 8938 or a 3520. But if you don't tell the US, they'll come after you with a stick, and no one wants that. Excuse me, Form 8621s, that's what you file if you have a PFIC. Thankfully, there is a de minimis amount of having a PFIC, so you don't necessarily have to do it if you've got a smaller amount there. But believe me, I've seen some ugly outcomes when people own diversified Australian mutual funds, ETF type portfolios, while still being US tax residents. Common pitfalls. This is really moving into summary territory here. Don't get hit with your 10% early withdrawal penalty. Don't take it all at once and get hit with the lump sum tax bracket shock. do remember to file your WABENs and be mindful of those Roth IRAs. See if you can distribute those before you move back in country. I mentioned some case studies, and here we have Sarah. She saves over 100 grand by executing the super recontribution strategy. So what's that look like? She's an Australian citizen. She surrendered her US green card. Let's assume she wasn't a long-term resident. So 8 of the past 15 years. Maybe she only had a green card for 5. She comes back to the US, submits her USCIS Form I-407, calls it a day. Her US tax obligations are over. Okay, she submits the WA-BEN to her US custodian. By the way, if people are unfamiliar with that word, custodian, that's what I'm referring to as Fidelity, Schwab. It's a brokerage firm, other people might call them, but they're the ones, if you want to know where your money lives, they live at the custodian and they have custody of your assets. That's why we use that term. So you claim, Sarah here claims a 0% withholding. So in reality, they probably do withhold 30%. But let's flash forward to April 15th. She files her 1042S along with her 1040NR, and she gets all that money back. So a little bit of a delay in that, but she's happy because she got her money back. Then she converts her 500 grand using WISE in this example. She gets a little less than $750,000 because WISE aren't doing it for love. There's a small fee in there. She shields some of that growth with making use of her concessional carryback 5-year contribution, and she shields $167,500, which saves her a whole bunch of money. And then she uses the remainder to, or what she can of the remainder, into a non-concessional contribution. As I was saying earlier, I think she could be smarter than that, given that this is April of 2026. She could actually use the 5-year carryback now and then wait until the new financial year, and she's got another $32,500 that she can contribute. And she's got, if she did $120,000 as a non-concessional now, wait till July 1st, and then she does another $390,000. Then she's gotten mega bucks into her superannuation, and hence why we call it the recontribution strategy. So what came of all of this? Let's go back a step. So by executing this, Sarah bypasses the 40% tax bracket, shifts her 500 grand US, 750 Australian into superannuation, where she's only paying 15%. It's as high as 15, it's as low as 10 on taxes within superannuation. Someone's chatted in, Andy, there for a younger migrant with decades of potential growth in 401k, would it be better to just go down path B initially over a longer period of time, or take the initial penalty of an early distribution from the US, but at a small, that's a really good question. Yeah. Too many variables, Andy, to be honest, because what's your income earning potential between Australia and the US? How much is your account going to grow? It's a great question, but that's the kind of thing that we would get into with a client, is exploring that sort of scenario. So case study 2, Michael here, he's avoiding 48,000 Australian dollars by using the periodic distribution strategy. Here's what it looks like. He's a dual citizen. He's got an $800,000 IRA. Most of it is growth, unfortunately for Michael here. If he took it all at once, that would be a very bad idea. He would get slapped with an enormous amount of tax, and it would hit him. It's hard to say. We're only talking about the Australian side here, but remember, if he's a dual citizen, he's also paying US tax on that as well. So $800,000, he's going to put himself into a 37% federal bracket. He's going to pay, it's just going to be a disaster. Compared with if he took it over 10 years, he's not spiking those tax brackets. So he's staying under the 22, in or under the 22% bracket. He remains under the 30% on the Australian side. Life's a little bit better, and he's saved $48,000. He didn't need to pay that to the ATO. So wrapping up here, a full complement of advisors in executing something like this would be the cross-border financial planner. That would be us, the ARAT here, your international CPA, your US qualified tax attorney. Maybe if your situation was pretty complicated, then the tax attorney might need to step in. That's really when the big guns are required for an opinion. You're Australian tax professional, again, with international expertise, like your regular mom and pop, tax provider. I would not recommend because they don't know what goes on with the US necessarily. And then, of course, your foreign exchange provider. Key takeaways and action items noted here. Next time, I'm not saying next month, I'm moving to quarterly presentations. I've been doing monthly for years and years, and that's been a lot of fun. But you're welcome, Karen. That's been a lot of fun, but clients come first. And so we need to focus on who we work with currently. But next webinar will be a continuation of what we've brought up here today, and that is how does US tax work on Australian superannuation? Answer is it doesn't. If you're not a US tax resident, you don't need to worry about that. But if you are, that is a green card holder or dual citizen, then you might have some issues to think about. All right, so questions and answers. There's some other resources listed here. You can also find other Arate webinars where we talk about this. Trudy, Karen, and Steve, and Alyssa, you're most welcome. Thank you so much. If you know of, if you are someone who could benefit from a consultation with us, then please feel free to reach out. Thank you so much. Have a wonderful rest of your day, everyone.